All right, so today's lesson is lesson number 8. Today is lesson number 8. But before I start lesson number 8, which we'll be looking at the basics of market structure, first of all, I want to take questions based on lesson number 7. So those of you that were able to go through lesson number 7, I uploaded the video, I think 2 days ago. If you were able to go through it, that is the way the candlesticks are formed, the patterns of the formation of the candlesticks. If you were able to go through it, then you can unmute yourself and ask your question, or you can type your question in the chat so that I will answer those questions before we begin today's lesson. All right, so the floor is open. If you have question, please unmute yourself and you can ask. Thank you. All right, since there is no question, so I think I'll have to just move on. Okay. So today we are looking at basics of market structure. Okay, basics of market structure. And when we talk about basics of market structure, it means I'm looking at the foundation. Okay, the foundation, the entire foundation of forex trading. Okay, so since most of you are very new to forex, I have to talk about the basics of the market structure before I go to the advanced market structure to make things easier for you. There are things I'll talk about here that when I'm talking about it during the advanced market structure, it may seem a little bit different, but then this lesson is for you to get the whole concept about how the skeletal nature of the forex market is. All right, please, if you can all hear me, type yes in the message box. If you can hear me, type yes in the message box. If you cannot hear me, type yes in the message box. All right, great. So let's go on now. So market structure is a very important topic that you need to pay close attention to. Now, if you get the concept under this topic, then you are well prepared for the rest of the concepts. Okay, but if you don't get this particular concept well, then you should know that the remainder of the what of the lesson is going to be a bit uh, kind of complex for you. So the market structure is something you need to pay close attention to and understand how it is. That's why I'm taking it from the basic market structure before we go to the advanced marking of market structure and all those stuffs. Now, personally, I refer to the market structure as the skeletal layout of the forex market. That is the backbone, okay, the backbone of the earth, of the market, of the forex market, because it displays the behavior of the earth, of the forex market. So that is why I personally call it the uh, skeletal layout. Please, someone said he or she is not seeing my screen. If you cannot see my screen, then I'm sure it's your network. Please, if you can see my screen, type yes in the chat. If you can see my screen, type yes in the chat. Like, I'm not projecting, you only see the trading view chat. Yeah, so the person who is not seeing my screen, please kindly check your network. All right. Okay, thank you guys for the feedback. All right, so let's proceed with market structure. Okay, we'll be able to determine the highs and the lows of the market. Okay, the highs and the lows of the market. So without much talking, let's look at how market structure can help us trade, uh, can help us as traders predict the behavior of the market. Okay, now we can use this market structure to determine when market is trending upward, downward, sideways. Sideways also means ranging or consolidation. Okay, so if we say the market is trending sideways, it also means ranging or what? Consolidation. And when market is about to end a particular trend and begin another, so market structure helps us to be able to what? To determine all these things. All right, I will do some illustration. Okay, I will illustrate market structure in two folds. Okay, I'll do what we call the textbook illustration, and then I'll do what we call the realistic illustration of the market structure, because there is a way people see market structure to be based on textbook representation, which actually is not so. And then we also have a representation that is based on realistic movement of the market um, in real time. Okay, so first let's take I don't want to touch this chart. I still have that uh, analysis running, so let me open another chart and use that to do the lesson. All right, so whilst the chart is loading, so first of all, I will look at the bullish trend. Okay, so we will look at the textbook example of the bullish trend. Then afterwards, we will look at the more realistic example of the what? Of the textbook or uh, realistic example of the bullish trend. All right. So now the textbook representation goes this way. You will see them drawing the textbooks. You see something like this, something like this. This is for the bullish trend. That is an uptrend. Okay, where we create what we call higher highs and higher lows. Okay, so let me end it over them. So now this lowest point here is referred to as the what? As the low. So in an uptrend, we'll be looking at two keys here, what we call the higher high and the higher low. Those are the key points in an uptrend. Okay, so anytime market breaks this point here, this very point, okay, let me label this thing for you. So this point here is referred to as the higher high. Okay, the higher high. Let me reduce the text. Okay, all right, so this guy is a high, this guy here is a low. So I'll label all for you guys. I think let me use caps. Okay, let me edit this also. All right, so we have the higher highs, the higher low. So every time there is a pullback, we have this formation taking place. We have this formation taking place. Anytime there is what? There is a pullback, we see something like this taking place. So this is what I mean. From the low, we form a high. Then we have a pullback. So this low to this high is what we call the impulsive move. Okay, that is the longest leg. So we call it impulsive movement in the market. Now, this movement from here to maybe halfway of the impulsive move is referred to as the corrective move. Okay, correction. Some people refer to it as pullbacks. Okay, so those are the two things you need to know. In a market structure, we have two phases: the impulsive phase and the corrective phase. Okay, so the longest movement in the trend is referred to as the impulsive movement, and the shorter movement in a reverse manner to the impulsive movement is referred to as the corrective movement. So it could reverse to 70%, 50%, 32%, or 60% of the impulsive move. Now, anytime price breaches a high, a new high is created. Okay, Now, when that new high is created, we refer to that high as a higher high. Why? Because if you compare this high here to the high that is here, you realize that the high here is greater than the high at the lower section here. This is why we call this next high a higher high. And when you come to, sorry, this label is wrong, please. That is a lower high, please. A lower high. A lower high. Lower low is formed in a downtrend, please. Lower low is formed in a downtrend. So that is a lower high. All right. And the reason why this is a lower high is because is what? Is above the previous what? Low in the uptrend. So we refer to it as what? As a we refer to it as a higher low. It seems like today my brain is dull. Guys, forgive me for this mistake. All right. So let me just correct them. In an uptrend, we have a higher high and a higher low because we are in a bullish trend. All right. In a downtrend, we have a lower high and a lower low. Okay. So please forgive me. All right. So let's continue. Now, once we move up, anytime we break this level, okay, so if we break this new level, it means the next high that is formed is higher than this previous high. Thereby, it is called a new higher high formed in the trend. And then the low that was formed from this pullback is referred to as the new higher low. As long as this low has not taken out this previous low, it is referred to as the new higher low. Good. Now let's continue. If this high is also broken and this high is formed, we again call this one a higher high. And the pullback that took out this high is referred to as the new higher low. It's referred to as the new higher low, please. All right. So let's move on. So this process repeats itself over and over and over again. But then when you look at the chart, when you look at the main chart here, you realize that the way I drew these lines specifically very straight up down, that is not how the market is moving. Okay, you realize that the market moves in a different pattern. So this is what I refer to as the textbook movement, and this is what I refer to as the more realistic movement in the market. So yeah, you realize market moving, okay, in this manner, moving, then you see movements like this. So this is how in reality the market moves, not the textbook structure that I drew above there for you. Market moves in this kind of way. Now, this is why a lot of people are going to what? Are going to be confused in how they mark the structure. So I'm going to move this drawing to this side so I can use it to explain. Now, this is the lowest point, the high low that was formed in the market. Let me just drag this label. So this high low, yeah, then this higher high also here. All right. Now, when you take this, you can see we broke this guy to create a new higher high, and market came down. But look at where this higher high was broken. It was broken here. Therefore, this particular high that formed here is not the new higher high in this structure. It is an internal structure formed within the main structure. Okay, so when we get to advanced structural marking, you begin to get this concept very well. So this is the new lower new higher high. That is the new higher high. Then this will be your new higher low. Why? Because this guy is the one that took out this high and not this guy. All right, let me admit someone. This guy here, was taken out by this guy. All right, so therefore this high here now produces this higher low down here, which now produces this new higher high. Okay, this new higher high. Now this new higher high produces this higher low, but this high here did not take out this previous higher high. Therefore we can't say a new higher high has been what? Has been created. No. So this guy is also an internal structure within this leg, okay, within this leg over here, and this higher low here will be confirmed once this guy is taken out. All right, and this guy was taken out here by this high to create this high, hence we have our new higher low here. Now the next higher point, higher high, is this. All right, so that is our next what? Higher high. All right, and let's see that higher high point created an equal high with this guy. So this guy never took it out, so we can't say this guy is the new high. No, but this guy over here was the one that finally took out this guy, so this become our new high, and therefore this is the lowest point in this movement. These are all internal structure, but this is the lowest point in this movement, hence this becomes our new lower low. So in reality you can see the complexity of the market, which is different from just this straight textbook movement I give you here, which a lot of books just give you as market structure and they don't explain further to give you the concept behind the complexity of the market in terms of the market structure. Now in reality, these internal movements are also structured on the lower time frame. So when you go to the lower time frame, you see them as what? As market structure on its own, which you'll be looking at once we move on in the lessons. All right, so you can see this behavior in the market continues going up and up, forming the same kind of what? Movements in the market. So you can see the next high is here because it took out this guy, then it created this low which took out this guy. That's why it is what? It is a confirmed higher low and not this guy. Then we now took out this guy, we create this high which now did a pullback to below this. So that is a proper correction, okay, which now takes out this guy. So in advanced market structure we will be calling this inducement. Inducement taken out to confirm the structural market correction, okay, so or pullback. All right, so we'll be looking at two types of market structure when we get to advanced structural marking. We'll be looking at the market structure in terms of candlesticks and structural formation in terms of inducement. All right, okay, so this is for the bullish market. All right, so take note of this point. In an uptrend, the market structure is always breaking to the upside. Okay, the structure is always breaking above. You see, the high is formed, we break it, we form a new high. A low pullback is protected because we didn't take out the previous low, which is here. then we form the next high here by taking out this high, make a pullback which is equal lows here. So market is still not broken the previous low over there, then we took out the next high, we produce it over here. So when this is happening, we say market is trending upwards, and this is characterized by the formation of higher highs and higher lows. All right, now the higher lows are created from the retracement that occurs after every break in market structure. So this point is the break in market structure, which we call BOS or BMS. So anytime you see something like this, BMS or BOS, break of structure, it is whether BMS or BOS, it is still telling you the same thing. They are telling you there is a break of market structure at that point. All right, which we'll be talking about to details in the advanced session. Now, note that the higher highs are always taken out while the lower lows are maintained or respected. What we mean by maintained or respected is that when it comes to the lows, you see that this low never came to break this guy, then we continue. The next low never came to break this guy, we continue. The next low never came to break this guy, we continue. The next low also form equal lows with this guy, and then we continue. So once that is happening, we are respecting the lows and taking out the highs, then you should know that we are in an uptrend. Okay, now when we can use market structure to write what we call an idea out of the market. Okay, so when a low is taken out in an uptrend, it gives us an idea that the bullish trend is ending. So now if let's say finally this guy here takes out this last low here, something like this, okay, then we are beginning to get the idea that the bullish trend or the uptrend is coming to what? To an end. So if we intend again even get something like this, a movement like this, and then we have a second break, okay, a second break of a low, then we know that we have now changed from an uptrend to a downtrend, because there is a double confirmation. The first low here was taken out, and then we have a high that did not go and take out this high, but rather continue to push down and take the low that was formed here. Once that happens, then we know that there is a shift in market structure. Once you see something like this, you see a previous high not taken in an uptrend, and another high is formed but didn't take the previous high, then it forms what we call SMC, SMS. Okay, SMS, shift in market structure. So it means market structure is shifting from bullish to bearish. All right, once you see something like, and a double creation of two creation creation of two lows then confirms that yes, we are moving in moving from an uptrend to a downtrend. So that's one thing you need to understand. So as I was saying, bullish trend, it gives us the idea that the bullish trend is ending and has ended, but this is not always so. Take notice. Hence, you need to have further confirmation. We will look more at this under confirmations, or what we call confirmed change of what? Trend, and unconfirmed change of what? Of trends. Okay, there is something you need to understand when to know whether the trend has fully changed or the trend has not fully changed. And that was what I was saying, that at least we need two lows to be formed So once we get another low forming here, then we know that one low, two lows has been formed in the market. It means we are what? We are now confirming that market has truly changed from bullish structure to bearish structure, and hence we begin to look for selling opportunities in the market. So once you get a confluence, then you can sell in the market. All right. So now let's look at before I go to the bearish illustration, let me take questions. So for those who came late, any question for maybe you didn't get some concept, well, you can unmute yourself or you can type the question in the chat session, and then I'll respond before we continue. We have about 20 to 30 minutes for this class to end, and then I'll see you on Saturday where we will look at practical examples. All right, so if there's no question, then I'll move on to the bearish demonstration. Okay, so let me take out these drawings, and let me look for a bearish structure here. Okay, so first let me
battery, please charge.
Oh, sorry about that. All right, so first let me demonstrate the how do we call it, the textbook example. Okay, where we have this kind of movement. All right, so you can see this kind of movements in the market where we have, so as I said, in the in a downtrend, we characterize the whole structure or movement by the series of lower highs and lower lows that are being formed in the market. Okay, so we have here the low, and then we have a lower high, a lower low, a lower high, a lower low, a lower high. Now, why do we refer to this point here as a lower low, here as a lower low, here as a lower low? It's just the same thing I explained in the bullish. If you take this low, the low here is lower than the low over here. Hence, we refer to this low as a lower low. If we come down here, this low is also what? Lower than this guy, so we refer to it as what? A lower low. Now, when we come to the highs, this high here is higher than this high here, so we refer to this high as a lower high compared to this, and then also this as a lower high compared to this. All right, now also in a bearish trend excuse me, in a bearish trend, the market structure is always broken to the downside. It's always broken to the downside. All right, so I think somebody is saying something in the chat. Samuel. Someone said, "Sir, please, the bullish trend, the prices are always higher." Yes, please, the prices are always higher. That is why it is creating new highs, which we refer to as the higher highs. Okay, and if you remember when I was teaching you guys on, I think um ranges, okay, we talked about dynamic range. Okay, when we were doing dynamic ranges, you see that I told you the price levels are dynamic because they are not on a horizontal line. So the dynamic range is an alignment of the bullish and the bearish trends. Okay, so they see price differences at each and every turning point. All right, so this low is also taken out, this low here also taken out, and then we create, and then the process goes on like that. All right, so I think let me just label 2 points here because it repeats throughout. So we have the lower low here, okay, and then we have the lower high, and it repeats. So I've explained it already, just labeling them for you to see. Okay, so this is the next lower high, this is the next lower low, and it continues like that. Now when we come to the chart, okay, so let's pick from this point to what, to the point here. All right, let's pick from here. So this is the first point. Okay, then we have this movement in the market. That area is an internal structure. We also have internal structure here. Then we have the main structure, and then we can see the major pull to the down before the change in direction. Sorry. So let's move this guy to this side a bit so that I can use it to explain. All right. Okay, so just as I explained the first time, okay, you can see that we are not on a downtrend in this structure here. Okay, we are on a downtrend. So we can see the first area here, this low here, was taken out. All right, the low there was what? Was taken out. Then the next low here was also taken out, confirming this high. So this was the high that took out this low. So this was our first lower high here. Okay, our first lower high. And then our lower low. Then once this low is taken, this lower high is what? Confirmed, and this lower low is also what? Confirmed. All right. But I will show you a proper way of confirming lows and highs in an uptrend and a downtrend during the advanced structural marking. Okay. So when we get to that point, you look at it. Just use this one as let me say the basics, so that when we get there, you will build upon it. All right. So now, if you see your mark here lower low, why? Because it created this high which took this particular low out, because it's the lowest point for this, and this particular side here is not a high, this is also not a low. It is an internal structure between this guy and this guy. Okay, it's an internal, since this low this high has not been taken by this guy before it breaches it, then we know that. So this is kind of like inducement that confirm this low, which we'll be looking at under the advanced structural marking. Okay, then we have the next point here. So this, after this taken out, we have this low confirmed by this inducement, but then later on taken by this guy to give us the next confirmed lower high and then lower low. All right, and now this was the last point that was created in the market. Then what do we see? We see market create a high that was not able to what, to take out this low over here. Okay, it wasn't able to take out this low, but reversed from this point here in the market. It reversed from this area in the market. Are you with me? Now doing so, then we begin to have the idea of shift in what, market structure, which in the bullish, this thing I showed you, SMS, shift in market structure. Okay, I'm coming, somebody is waiting, let me admit them. All right, so here as it reverses here, we have a shift in structure. Market never came back to what, to take this last low. So it means that we begin to have an idea that market is about to change direction from a bearish structure to a what, a bullish structure. And now you can see market again. If I was to continue to draw, you could see that after it tap into this demand, market shift up, and then we begin a bullish trend. So This is the basics of the market structure, which we'll be looking at into details as we move on in these lessons. Okay, so let me repeat the key things that you need to know. Okay, now as I said earlier, you should understand that in an uptrend, market forms series of higher highs and higher lows. That is the characteristics of an uptrend. And in an uptrend, market is always breaking structural to the upside. Okay, so it is breaking the highs and creating new highs, but in terms respecting the lows in the market. Then in a bearish market, we are now breaking the lows and respecting the highs. Okay, that is in a bearish market. We break the lows, so market structure is broken to the downside in a bearish market. So that is one thing you need to get an understanding to in this lesson, or the main characteristics in this lesson. Sorry, I've not been feeling well for some days now. I'm having some cold, so forgive me about my voice today. I'll now open the give the opportunity out for questions before we end the lesson. So if you have any question, just drop it in the chat, or you can unmute yourself and ask your question. No question?
All right, so I have a question. I couldn't join earlier to ask at the beginning of the class. So it's about the last video on the candlesticks.
Okay.
So it showed us how two scenarios or two sequences by which candlesticks are formed. Now
Yeah.
this sequence is some you come and meet the candles formed already, or you see a candle being formed. So, what's do you need to know how exactly the candle formed, whether it formed by sequence one or sequence two, or maybe you access to go and read about or find out how other ones are formed. Maybe there is a third, fourth sequence. Do you need to know exactly how it was formed? Because when you come and meet the candle, it has already established its move. So you may not get to know exactly whether it formed by sequence one or two or three. So do you need to know how it formed? Should you be there to know how the candle formed? For you to know that okay, this is how the candle formed. So it is not, although it is a full bullish candle, it's having a bearish sentiment. Or although it's a full bearish candle, it's having a bullish sentiment. Please, do you
All
get my
right.
question?
Yeah,
Okay.
I get your question perfectly well.
Okay.
So I'm coming, let me share my screen. I think you are talking based on, I hope you all of you can see my screen.
Sure.
So this is what you are talking about.
Exactly.
Yeah. So here all you need to understand is you don't need to know the sequence that is forming. What you need to understand is what we are explaining to you here is to know that these are the kind of ways or the manner in which market forms.
Okay.
Okay, or
Okay.
each candlesticks forms. All right.
Okay.
This especially helps you to understand the formation of the daily candle, because when on the price chart, okay, you'll be able to use what we call period separators. And those period separators for the day, if you break it down, if you open the if you change into maybe let's say H1 15 minutes, the the period separator will give you from when the market open to when the market is closing, and based on that, the movement of the market at that time will tell you the kind of sequence that occurred, and you can use that as a knowledge to predict the next movement of the market.
Oh, okay. So you mean this is reflected in lower time frame. When you switch from a higher time frame to a lower time frame, this is reflected there. So you can
Yes,
have an idea of how it formed.
exactly.
Okay, so you don't necessarily have to know for each candle how whether it formed by this sequence or that sequence. But switching from a higher time frame to a lower time frame can give you that idea instead.
Exactly.
Okay.
Yeah, Enoch. Enoch, you can unmute yourself. You raise your hand.
Okay, I wanted to respond to his question, but it seems
Oh, okay. If you
you
have
have.
anything, you can still add.
Uh,
All right.
I
So Legacy. I think Enoch is
think
done. So Legacy, you can unmute yourself.
Okay. Boss, my question is
the same thing as
during bearish,
I wanted to tell him that when you're analyzing the market, you look at what happens first in the bigger time frame.
Okay, Enoch, I think your network is breaking. Legacy, you can continue.
um, during the lower low and lower high.
Yeah.
Um, what I know was before the market can shift direction, it has to break the lower high
Okay.
before maybe
Before. Hello. Your Legacy.
I can see that the lower. I didn't see that the lower high was broken. The lower low was created, but the lower high wasn't broken.
Okay. Yeah, I get you. That's why I said this is a basic overview of structure. Okay. We will look at this thing. How they call it? The advanced market structural marking. There is certain things you need to understand in terms of what we call inducement and all that. Okay. Now,
Okay, sir.
the market structure is such that whatsoever happens on the higher time frame happens on the lower time frame also. So on the higher time frame, there will not be a change of market structure, but there could be a change of market structure on the lower time frame. So you remember I was mentioning internal structure. Okay, those internal structure form on the higher time frame are major structural levels on the lower time frame. Okay, and those levels create what we call changes of what character, flips and inducements that make certain confirmations that we'll be looking at when we start the advanced structural marking. Please, are you clear with that?
Yes, sir, I'm clear.
All right. Clote, how how can you, when the trend has changed, need to go to the market? um I don't get your, this thing is not, Clote, I wish you can unmute yourself. Your this thing is not clear. The message is not clear, so I wish you can unmute yourself and then ask your question so that I can get clarity.
Sir, I wanted to know how can you go to the market when the trend, how will you know when the trend has changed and you need to go to the market?
Okay, so that was what I'm saying, that we will be coming to that. Today I'm just giving
Oh,
you the basics of the market structure.
okay.
Yes.
And secondly, can you take some small few candlesticks when the formation of the lower low, maybe 2 or 3 candlesticks before you can close it?
Your question is not very clear to me. I don't know if you can put it in a way I can understand you better. I don't know what you
Like
mean by like you can take few candle.
like when you are on the downtrend
Yeah,
and you see a spike immediately
yeah.
after the spike, can you take maybe 2 or 3 candlestick and
Okay,
close the
okay.
market?
Meaning you are being specific with boom and crash.
Yes, sir. Yes, sir. Yes, sir.
Well, it depend on uh, the concept you are using to trade or the strategy you are using to trade. Okay.
Oh, okay, sir. All right.
Yes. With the strategy or with the concept we are learning right now. Okay. One beautiful thing about it is, and most of my students are on the course, like previous students are on the course, so they can attest to that. One beautiful thing about it is that you can use it to trade any instrument, all right? And you
All
can
right.
even use it to trade boom and crash. You risk, like it will shock you, you risk about $10 and be making about $100, $80, $50 on that $10 you are risking with about 2, 3, 4, 5 positions. Get
Oh,
the
okay,
point?
sir. All right.
So it's just that you have to be patient so that it's like because of the newbies, I'm taking everything from scratch.
Okay,
I
sir.
getting
Okay.
it.
All right.
So you today actually I was not supposed to have class because I'm not feeling very well. But then I just don't want
So,
to disappoint you guys. That is why I force myself to have the class this
oh,
evening.
all right. All right. Thank you very much.
All right, please. Any other question? Okay, guys. So if there is no other question, then I will end today's class here. I'll try as much as possible and see if I can upload the video today. If not, then tomorrow morning I'll upload the video for you guys, and then you guys should do well to watch the videos. It's surprising that the people that are watching the videos are even not on the page. It's shocking, and it's so also interesting that we have about 360 people on the page, but then the videos have about few views. Well, it showed me that most of the people on the page are not there to learn. I think they are waiting for me to start saying buy this, sell this. Then they will be waiting for a very long time because until I finish these lessons, I'm not doing that. I want all focus should be on the learning. And the thing is, when you learn and understand the concept, if I come and say buy this, you know why I'm saying buy it. If I say sell this, you know why I'm saying sell this. But if you don't have the concept, if you don't have the understanding, and I come and just say buy this, why am I saying you should buy it? What did I see before I'm saying you should buy it? And some people even will come late. They just see buy and all, they start buying. They don't even check the time you place the signal there. Are you getting the point? So I see a lot of them leave the page, and I know that is the reason why they are there. Are you getting it? And I'm not bothered about that. I am just here to help train people to get financial freedom. So those who are ready to learn, learn and learn well. If not, well, I'll do my part and leave the rest to you. So guys, have a very wonderful evening. I will see you on Saturday. Please, today we came late, but let's not be late on Saturday. Thank you.